You can start, Ashika.
Yes, sir. Good afternoon, everyone. I, see Ashita Shah, extend a hearty welcome to everyone on this beautiful afternoon. I, on behalf of WIRC, wish you all a happy Navratri. May this festival enlighten your life with happiness. I welcome you all to this yet another session, rather a dynamic session of issues on tax audit of our WOW series. Indeed, this series has proved that we women are really wow when it comes to any platform, be it professional or social. Today, we are fortunate enough to have with us Dynamic Chairman WIRC CA Manish Gadia with us. I request Manish sir to share his views with our participants. Over to you, Manish sir.
Thank you, Ashita. But before I will start, I request Mishra ji to kindly play the ICI motto song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैत 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 एतद्द्वैत.
Good evening to all and happy Navratri. And Navratri, we always celebrate and pray to the goddess. And today we are discussing and we are in the WOW series, that is Women on Wednesday. And you all know what is the theme of this entire concept. This is the 8th in the series program we are having, and what we believe that the women are the best teacher in the world, and that what we are doing that in the WOW series, the faculties will always be women. And today we have one of the finest women faculty as far as direct tax is concerned with us, CA Saroj Maniar. So as far as women are concerned, under the Women Empowerment Committee, our dynamic chairperson, we have taken various initiatives. The first such initiative is WOW, that what you are listening to. Another initiative is Coach, where on the website of WIRC you will find an icon called Coach, where you can click and you can register. A woman chartered accountant can register herself and offer their services to a firm or to a company, maybe on part-time basis, assignment basis, or maybe full-time basis. So this service is absolutely available free of cost. So most the movement can take the benefit of this. In last 7 months, WIRC has come out with 17 different publications. And all these publications are available on sale. You can go to the WIRC website, purchase, make the payment, and purchase the publications. Apart from that, Direct Tax Committee has started a charitable help desk also for the benefit of members, because now 12A has been amended and all the charitable trusts required to re-register themselves. Apart from that, we have also started, as far as direct tax is concerned, direct tax study group, where members are meeting every month and discussing about the income tax provisions in detail. I will not go into the detail of the whatever the initiatives has been taken by WIRC. It is available on the website also. So WIRC is available on various social media, be it YouTube, be it Instagram, Facebook, or we have also started a podcast of our premium program. So be connected with WIRC. Thank you, everyone. Over to you, Ashita.
Thank you, Manish sir. Today, we are fortunate enough to have experienced and learned speaker with us, CM Saroj Maniar. It's an honor that she is with us to guide us through the issues in tax audit. I request Forum Bhanushali to formally introduce our speaker.
Thank you so much, Ashita. I thank the entire WRC team and WRC Chairman CA Manish Gadya for giving me this noble task of introducing the speaker for the day, CA Saroj Maniar. Sarojji is a qualified chartered accountant and a rank holder in the final company secretarial examination. She has a professional experience of more than 30 years. She was a managing partner of Maniar and Maniar Chartered Accountants prior to its merger with the CNK Associates LLP, which was about 12 years back. Currently, she is a partner with CNK and Associates, specializing in the field of direct taxation, representation, and advisory. She is actively involved in various professional forums and has been a member of the Direct Taxation Committee of the WIRC of the ICAI, and currently is also a member of the Taxation Committee of the BCAS. She has delivered talks on various professional subjects at different forums and has also contributed articles to the Economic Times, Times of India, Outlook Investor, and a column in Mint. She loves traveling, going for walks, and relaxing. With this brief introduction, let's welcome the speaker for the day, CS Saroj Maniar. Thank you, ma'am, for being here.
Thank you. Thank you for the kind words. Thank you, Manish ji. Thank you, Forum. Thank you, Ashita. Indeed, it's a pleasure to be here amongst co-professionals, and it's a forum where we can jointly discuss issues and jointly learn together. So the idea is to share my experiences, share certain practical experiences, and I look forward to listening to different kind of questions and different comments and different solutions to some of the issues that we have raised. So we will start with the presentation. This one. Yeah. Whenever I talk about tax audit, I cannot but remember the time tax audit was introduced.
Okay,
Can you hear me?
Thank you.
Yeah. Okay. I always kind of go back in memory lane and remember when tax audit was introduced. That time I had just started my articleship. This was sometime in 1984. And it was, a big hue and cry. It was a lot of work for the profession. And the idea was the tax audit was introduced basically to ensure that the books were properly maintained. And to help the assessing officers to determine the true income. In fact, in those years, maybe I'm talking about 35, 37 years back, I think all the cases were selected under scrutiny. So there was a scrutiny for all returns filed every year. So this tax audit was introduced to help the assessing officer to reduce his burden of verification of certain things and to help him to compute the income correctly. And that time there were about 12 clauses, and they were very, very factual clauses. There was factual information to be provided, and in order to help them to assess the income. But today, flash forward, come back to where we are today. We have 44 clauses. If we count the number of sub-clauses, I think it would certainly be 100 plus. It is no longer factual. It is a lot of subjectivity. It is a lot of, taking a subjective call. So it is not that A plus B equals to C. It is much beyond that. So tax audit has really changed. And in fact, I sometimes wonder, we all know that the audit report for a tax audit is not true and fair, it is true and correct. So the stress is on the accuracy, on the factual correctness and accuracy. But the kind of stance that one has to take, it always is subjective, and I think it is time that the tax audit report should be called as a true and fair report instead of a true and correct report. So with this, brief background, we will look into certain clauses, certain issues, because instead of going through the entire form, what we've decided is looking to the topic. We'll only look at certain issues and the view that can be taken, that over the years, the stands that have developed. And if there are different questions, different views possible, happy to, have a discussion on them. So we just go to the what is the scope. So today, if we are conducting a tax audit in the case of companies, since the audit is already done under the Companies Act, there are only particulars in Form 3CD which have to be certified. If one is not the statutory auditor, one can certainly place reliance on the report of the statutory auditor for the purpose of the financial statements. There is a standard of auditing 600 using the work of another auditor. Of course, there would be additional verification that may be required. So, for example, if the same firm is the statutory auditor and the tax auditor, when one is doing the tax audit, one is not re-looking or re-verifying everything. So, for example, when we say additions to fixed assets, so in the course of the statutory audit, when one has verified or one has vouched those additions, one need not do it again. But if one is not the statutory auditor and is only the tax auditor, obviously there would be certain additional processes that would need to be undergone. So some additional verifications. And obviously the particulars given in Form 3CD have to be correlated with the disclosures in the financial statements. And there are a lot of common things. There is a lot of information other than what is mentioned in the balance sheet P&L. There is a lot of informative notes which are there. And when we go ahead, we'll look at some of them. For the corporate entities, the format of the financial statements is as per Schedule 3, as we all know. Even if the companies are following a different year-end, I mean, in today's time, there are not too many companies which are doing that. But for the March balance sheet also, for the tax audit report, the format is same as per Schedule 3 of the Companies Act, and it requires the previous year's figures. When we come to tax audit of non-corporate entities, so entities which do not have any other mandatory audit. So like, for example, an LLP still may have a mandatory audit under the LLP Act, but a partnership firm may not have a mandatory audit. So there, when a tax audit is conducted, it is a general purpose. It is when the financial statements are prepared, it is a general purpose financial statements. So when we look at Form 3CB, which is the audit report, it is not a true and correct, it is a true and fair report. It is a true and fair view of the financial statements. So as regards the format for the financial statements, it's recommended by the ICAI. It follows the old Schedule 6 format, where the balance sheet is in a horizontal format and the P&L is in a vertical format. And the format also mentions previous year's figures. Now, we have seen in a number of cases when the tax audit is done for a proprietary concern, say for a professional or a entity which is not a very large concern, which is not a very whose accounts are not very formally maintained and who does not have to submit accounts, say, to the bank or anything. There we have often, we've seen in certain cases that the previous year's figures are not mentioned, but it is strongly recommended that previous year's figures should be mentioned, because that is what the guidance note has recommended. As we said, the tax audit is primarily fact-based reporting. It is not opinion-based reporting. whilst we will see some of the clauses, it really needs an opinion to be given. It really needs a stand to be taken, because there are different views. The department may have a different view. There could be conflicting decisions on which you could be taking a particular view. So we will see some of those. The idea of the tax audit report, or the genesis of the tax audit report, is to provide assistance to the revenue authorities to compute taxable income. One important thing is not all the reported items are disallowed. So there are certain clauses where there is a disclosure requirement, but a disclosure is not an automatic disallowance. There are times when the tax department also misses this point. The tax department automatically kind of disallows, and we will see some instances of those and what is the best way to handle that. Reliance binding nature of the guidance note. Whilst the guidance note is, it is a strong recommendation. So when, as a professional, one is carrying out the tax audit, one should take guidance of the guidance note, so that in future, even if there is a problem or a challenge, say by the tax department or any other issues, if you have relied on the guidance note, that would really go a long way in helping. And the guidance note not only talks about the process, it also talks about the documentation. When we do a tax audit, we must remember that the primary responsibility of the information is that of the management. As a tax auditor, you are not supposed to go and get all the data. You are not supposed to extract or prepare all the data. That primary responsibility is of the management. Certainly from a practical perspective, looking to the size of the client, sometimes it does happen that we have to help, we have to guide, we have to sometimes even assist the client to prepare the data. But I think our role should be restricted to kind of guiding them how to do it, and not sitting in their chair and not sitting and doing it. For debatable issues, we must have management representation letters. All this documentation is also important for peer review, because we all know tax audit is also an attest function. We should follow the standard of auditing 230 for the audit documentation. And I think this is a favorite statement of my audit partners. Whilst I am primarily a tax person, the favorite statement is that the golden principle for documentation is write what you do and do what you write. We should always look at this reference material which is available to us. So we have the ICAI guidance note 2014 edition. Thereafter, there was an implementation guide after all those transfer pricing related changes were made. There is a recent tax audit checklist. This is, recent meaning it's about a year back. This is a checklist for tax audit, which has been issued by the institute pursuant to the quality review board. They had come up, they had verified some of the tax audit reports issued, and they had come up with some comments, and basis those comments, they have kind of issued a checklist. So this checklist is a good idea to keep on record for the tax audits which are being done. ICDS related, there are notifications and clarifications. And obviously, the other reference material is our Income Tax Act, because I think no matter what you do, no matter which reporting you do, I think every time it's very, very important to have a look at the Income Tax Act and the related rules and notifications. Like our Gita is the Income Tax Act. So this year, let's look at the extensions. Obviously, the extensions were expected because of the lockdown, and originally, there have been extensions which have come twice, and as recent as sometime in September. And I was looking at the circular, and I have tried to summarize what the circular says. So the first point, where it is filing by ITRs or by persons other than companies where no tax audit is applicable, 31st July, that's December. So that's very clear. We are not really talking about that category today. Then there is the circular mentions filing of tax audit report and other reports, where the original due date was 30th September. That is revised to 15 January. Then there is filing of ITRs by those assessees which are liable for audit. So basically 30th September, then the corresponding due date for tax audit has become 15 Jan. So corresponding due date for filing the return has become 15 Feb. Because now, as we all know, that the tax audit report due date is linked to the due date of filing the return. So it is 1 month prior to filing the return. Similarly, then there is filing of transfer pricing report, which is normally October, which has become 31st January. And in those cases, the ITRs are due on 28th February. And then for filing the revised or belated returns for AY 22-23 are, rather 21-22 are is 31st March, 22, I'm sorry. So whilst there is in the circular, there is no mention of tax audit report where there is a transfer pricing. There is, if you see all this category, there is no specific mention of a tax audit report. And when I speak about tax audit report, I also include all the other reports. You know, it could be ATJJAA, it could be your Section 10AA, it could be your exempt deductions under ATIA, IBICI, etc. So there also, it is always connected with the tax audit report. So there is always a reference of tax audit report and other reports. So in cases where the transfer pricing report is due on 31st January, the question is, when is the tax audit report? To my mind, in that case, also tax audit report should be due on 31st January 2022, because that due date is always linked with the due date of filing the return. And since the due date of filing the return is extended to 28th February, it should be 1 month prior to 28th February. So which means 31st January. Though the circular does not have a specific clause for that. We all also know that despite the extension in the due dates, if self-assessment tax is payable, then interest would continue to be levied under 234A if we have, if the self-assessment tax payable exceeds 1 lakh and it has not been paid before the original due date of filing the returns. So that's something which we need to keep in mind. Now coming to applicability for tax audit. So this is, since there has been an increase in the turnover thresholds for tax audit, I thought we'll, quickly run through this also. So when you talk about a person, if the turnover exceeds 10 crores, tax audit is applicable, no two questions. If the turnover is, if the business is with a turnover below 10 crores, then what you need to do is you need to see whether the cash receipts and cash payments are less than or equal to 5% of total receipts. If that is the case, tax audit is not applicable. So basically, if you have a turnover up to rupees 10 crores and your cash receipts and payments are up to 5% of the total receipts and total payments respectively, then you need not have a tax audit. And we will again come to what do we mean by cash receipts and cash payments. Now, if the cash payments and cash receipts exceed 5% of the total receipts where the turnover is less than 10 crores, then again there are two categories. One is the companies, LLPs and cases which do not fall in the presumptive income, and companies or rather individuals, HUS firms who fall in the presumptive income. If the companies and all, because presumptive income is not applicable for a company and LLP. So if you do not fall in the presumptive income, if the turnover is more than 1 crore, the tax audit is applicable. If the turnover is below 1 crore, tax audit is not applicable. So basically for a company, if your cash receipts, if in case of a turnover between 1 crore to 10 crore, if your cash receipts are more than 5% or your cash payments are more than 5% of total cash payments, then you have a threshold of 1 crore only. Now we come to non-company, non-LLP. So which means we come to individual HUF firm who are eligible for 4480, who are eligible for presumptive taxation. So there, if the turnover exceeds 2 crores, tax audit is applicable. If the turnover is up to 2 crores and they opt for 4480, they opt for presumptive taxation, then it is not applicable. If they do not opt for presumptive taxation, that means their profits are below that 8% or 6% as the case may be, then tax audit would be applicable. For a professional, it's pretty simple. If the professional receipts exceed 50 lakhs, tax audit is applicable. If it is below 50 lakhs and 50% of the profits have been declared, tax audit is not applicable. Otherwise, tax audit is applicable. Let's see what are the conditions for this enhanced limit of 10 crores. What the section says, and this is section 44AB itself, it says that this enhanced limit of 10 crores applies in respect of taxpayers where the aggregate of all amounts received, including amount received for sales, turnover, or gross receipts during the previous year in cash, does not exceed 5% of the said amount. So there was a lot of discussion as to if the receipts are not towards sales, if the receipts are, say, towards receipt of capital in the case of receipt of share capital or something, or any other receipts, say sale of fixed assets and you've got some cash receipts, what happens? Similarly, even for the expenses, the language is aggregate of all payments made, including amount incurred for expenditure in cash during the previous year, does not exceed 5%. So whilst there's no explanation in the Act itself, the use of the term including implies that all cash receipts and cash payments should be considered. Now, when you go to the ITR, because ITR 5 and ITR 6 they've been released, that we were looking at the schedule where they have to give audit information. So there also it clearly says that, and there, whilst the ITR can never override what the provisions of law are, but today we are talking about from a practical perspective. When you are mentioning anything in the ITR, what would you mention? So the ITR is saying whether the aggregate of all amounts received, including amount received for sales, turnover, or gross receipts, or on capital amount, such as capital contribution, loans, etc., during the previous year in cash, does not exceed 5% of the said amount. So what would one do? How would one, vouch that? How would one look at that? So I think the only option is you will have to look at your cash book, and you will have to see that what is the amount which is coming in your cash book. When you look, whether you look at cash book, or you may also have to look at your bank statements to see that whether all the cash withdrawals are, properly accounted for and properly reflected. And in fact, there is also, when you look at 44AB, when they talk about the first part, the aggregate should be aggregate of payments made, including amounts incurred. They also mention that any payment by check which is not an account pay check will be considered to be cash. So very often, from a practical perspective, we have seen that if a check is issued which is not an account pay check but in the name of the recipient, that also should be considered as a cash payment. And sometimes it becomes very difficult to find that out, because different banks follow different practices. Some banks would write cash, some banks would only write the name of the person in whose name the check is received. So we have to again rely on adequate management representation. So it's very, very important to take adequate representation of the stand that is being taken. So before determining as to whether this threshold of 10 crores should apply, I think some documentation, whilst obviously if tax audit does not apply, we are not vouching anything, we are not certifying anything, but we must explain to the clients that you need to have adequate documentation to prove that it is less than 5%, to prove that both the receipts and expenses in cash are less than 5%. Similarly, if the assessee does not opt for presumptive taxation and wants to declare the profits lower than the presumptive rate provided under these presumptive tax provisions, tax audit is applicable, and we will further see, which are the respective clauses. Also, if a person has opted out of the presumptive tax rate and in the subsequent year he offers the income under the regular provisions, then for a period of 5 years the presumptive provisions will not apply. So which means for the next 5 years he or she will necessarily, or the firm will necessarily have to go in for a tax audit. And we will also look at what 44ABE says. This is again a common question that a number of clients have, that how do you determine turnover, especially when it is on the borderline. Sometimes you have, if for example you're looking at a limit of 10 crores, there would be some receipts which if you exclude the turnover is below 10 crores and vice versa. So we'll just quickly look at some of the items of the turnover where there could be different views. And obviously, the guidance note in a number of places has said that you will have to look at the facts and circumstances of each case, and there cannot be, any rules for some of the clauses. So guidance note also says that sales, turnover, gross receipts, they are commercial terms, and you will have to construe it in accordance with the method of accounting regularly employed. So for example, if some items, and typically, whilst GST is not to be included in turnover normally, if an assessee is including GST in the financials as part of revenues, as part of turnover, then it would become very difficult to say that for the purpose of determining the threshold, it is not turnover. Very often it is your disclosure also, which is very, very relevant. So whilst, as I said, GST is not to be included since it's collected on behalf of government and normally credited to a separate account. If it is not reduced, if it's included and the GST payment is shown separately as an expense, then it will be considered as turnover. Now, sales proceeds of fixed assets. Typically, this would not be turnover because this is not part of your business receipts. Sale of scrap. Typically, sale of scrap would be part of your operating receipts. So it would be included in turnover. There was a particular decision where it said that since the sale of scrap is in respect of certain raw materials and it was reduced from the cost, it was not accounted also to the credit of the P&L. In that case, it was not held to be part of turnover. Sales proceeds of shares, properties held as investment, typically not part of turnover unless it is a NBFC, unless it is a company which is an NBFC whose business is that of investments. Sales proceeds of shares, properties held as stock in trade, certainly part of turnover. Sales by commission agents, share brokers. Again, it would depend that if all the significant risks, rewards of ownership belong to the principal, the sale shall not be part of turnover but if it is on principal to principal account, then it would be part of turnover. Also, we will see when we go to the next part of gross receipts, whether it is being routed through the account. For example, in the case of share brokers, the share brokers actually receive the gross amounts, they retain their brokerage, and then in the pay and they have to pay. So in that case, it would certainly be part of gross receipts of business. Then rent received, again, normally should not be part of turnover unless it is the business of the assessee to, the assessee is in a real estate business or business of leasing or something. Dividend received, normally again, if it is purely investments, it should not be part of turnover. But if the assessee is an NBFC and it is the shares are held as stock in trade, dividends would be part of turnover. GST, normally not part of turnover. Then we look at what are gross receipts. So gross receipts include all receipts, whether in cash or kind, and which will normally be part of the business income, which will normally be included in the in the credit of the P&L account. And in case of reimbursements, if it is a pure reimbursement, if the assessee is a pure agent and it is a pure reimbursement, it is only a pass-through kind of receipt, then it may not be part of turnover. But if it is a reimbursement and some markup is charged or GST is charged on that reimbursement, then certainly it would be part of the receipts. Similarly, export benefits received, it would be part of the receipts. Interest received by a money lender, since it's part of business of the money lender, it would be gross receipts. Exchange difference, again, depending if it is more in the nature of a finance activity, it may not be part of gross receipts of business. If it is insurance claims other than fixed assets, normally it would be part of the operating receipts. Package 2 charges recovered by a travel agent, again depends on whether it is a principal to principal activity or it is a pure, the travel agent is a pure agent and it is only receiving and actually paying without any markup. Share of profit of a partner from a firm should not be included. Write back of amounts payable by creditors. To my mind, it is part of the operating receipts, but the guidance note says that this is not part of your gross receipts of business. So I think we can safely take that. In certain cases, and this has been a bone of contention between the tax department and the assessee. And the reason I've taken this up because in the last 1 or 2 years, since the share markets have really done well, there have been a lot of people who have done investments and who have done trading activities. We thought this may be relevant. So if there is a pure investment which is done, if it is out of own funds from a long term and pure investment, tax audit is not applicable. And then whilst there is no clear guidance, I think over the years there have been a lot of litigations and the department has now accepted certain certain criteria. So certain criteria such as if you are using own funds, if the average period of holding is reasonably long, if the frequency volume of transactions is it's not a daily buy and sell, then the department has by and large been accepting that these are investments, subject to how it is accounted in by the assessee and how it is been accounted not only in this year but also in the past. Similarly, for share trading, where it is actual buy and sell, sometimes a square off during the same day, there it becomes very difficult to say that this is investment. So there one will have to take that into consideration for the purpose of determining turnover. Similarly, for derivatives, futures, options, for all these speculative transactions, tax audit would be applicable if the turnover exceeds the threshold limits. We have also seen instances in the past and where there are two portfolios of an assessee. There could be an investment portfolio where the intention is to hold it for a longer term period and purely investment. And there is a trading portfolio. And the trading portfolio, the income is offered to tax as business income. But for the investment portfolio, it is offered to tax as capital gains. And that also has been accepted depending again on the method regularly, the stand regularly taken by the assessee. So we have seen in some cases where the assessees have kept separate demat accounts, one for investment portfolio and one for trading portfolio. In that case, the stand of the assessee becomes even stronger because it could also happen that the same scrip perhaps is traded as well as kept for long-term investment. And as long as you are able to bifurcate that into two different buckets, that kind of strengthens the stand. Now, in case of speculative transactions, how do we determine the turnover? we have to take the aggregate of both the positive and the negative differences. In case of derivatives, in case of futures options, again, aggregate of favorable, unfavorable differences have to be taken. The premium that you may receive on sale of options will also be included in the turnover. Delivery-based transactions, again, depends on whether the transaction is undertaken in the course of business or as an investment. So there we will have to see the facts and circumstances of each case. Coming back to what are the different clauses of Section 44A. So you may be covered by any of the 5 subclauses. And the first subclause is when you're carrying on business, if the total sales turnover or gross receipts exceeds 1 crore or 10 crores, as we saw in certain cases. Or carrying on profession if the gross receipts exceed 50 lakhs. Then the next one is if it is carrying on business and the deemed profits, the profits are lower than the deemed profits. The profits are lower than certain of these provisions relating to certain deeming provisions relating to certain types of business, whether it is transport business, whether it is oil, whether it is shipping, and so on. Then the next is if you do not fall under the presumptive tax provisions and you claim that your profits are lower than the threshold of 8% or 6%, as the case may be, and your profits are lesser or you have higher losses, then your tax audit is under 44AB subclause D. And the last one is if you are carrying on business where you have opted for the presumptive taxation earlier and then you have not opted for it for the next 5 years and you are opting out for it. So there, irrespective of your turnover limit, as long as your maximum amount which is not chargeable to tax is or that threshold is breached, you have to carry on tax audit. This is a relatively one of the subclauses is a new provision, and that is why we thought we should discuss that. That where the provisions, where the assessee has opted for taxation for these new regimes, where there are based on a certain threshold, you have a lower rate of taxation. And this year, the new provision, we will straight go to what is the new provision this year. And we will look at what are the relevant provisions. So this is basically for individuals where they do not want to claim deductions under Chapter 6A. Then the rate of tax that is applicable in their case is a lower rate of tax. So this provision, it may not be a provision which is very useful to a lot of entities, because the tax differential is not very high. It is instead of your 10%, it is 5% instead of the 20% threshold. So there are different, within the slab rates, there is a certain tax saving. And let us see what are the, the conditions to you get into, what are the conditions for these provisions to be applicable. So this is effective from AY 21-22. And taxpayers who have business income, they can also exercise this option on or before the due date of filing the return of income. And once they have exercised this option, it will continue to apply for the subsequent years. And it can only be withdrawn once in a lifetime. Whereas for individuals who have salary income, we know that year on year, they can choose to exercise that option. But for business income, they would not be able to do it year-on-year basis. And once you have withdrawn from that option, once you have exercised in year 1 and thereafter you have withdrawn from that option because you want to claim deduction for making investments, say your Chapter 6A, or you want to claim additional depreciation, then in future you will not be able to claim the low benefit of this lower rate of taxes unless your business income ceases to exist. I'm sorry. Then the adjustments to the written down value of the assets will need to be made in the manner that has been prescribed. So what is this adjustment? that today, if I am an individual who is having some unabsorbed, I'm a proprietary concern having certain unabsorbed losses and certain additional depreciation, unabsorbed business losses, unabsorbed depreciation, which comprises of a part of additional depreciation. Then there is a corresponding adjustment to the written down value, because the amount pertaining to the additional depreciation is not allowed to be carried forward for future set-off. So that adjustment will be made the opening written down value. Similarly, in such a case, the loss from under the head income from house property will not be eligible to be set off, and there is a form which is required to be furnished. So these are the provisions which are applicable for the first time in AY 21-22. One of the new provisions which was introduced in the Finance Act was about was relating to the partnership firms, was relating to tax implications in the hands of the partnership firm on retirement of a partner. So we know that in the past there have been various decisions wherein on retirement, when a partner has received an amount in excess of what is there in his capital account or has received a property, there has been a tax advantage. There has been a tax benefit and a tax advantage. To bridge this gap, this amendment has been introduced now, and this amendment is effective from AY 21-22. As far as tax audit report is concerned, what is our role? What is it that we have to do? So there are certain reporting requirements. So we have to give details relating to the profit sharing ratio, and we have to give details as to is there any change in the profit sharing ratio. So whilst there may not be any direct impact in the tax audit report, these provisions have to be kept in mind because there could be a tax implication when the return of income or when the computation of income is being finalized, and this would be triggered by virtue of giving this information. So whenever there is any change in the constitution of the firm, the tax department will look at it as to whether there is this change in constitution of the firm or this reconstitution of the firm is by way of receipt of any asset by any of the retiring partners. So this is more of a disclosure, but we need to keep this in mind. We need to keep the implications in mind. The other issue is about the nature of business. While this is, it's a very, very basic clause. It's a very simple clause where you need to give the nature of business. And if there is any change, you have to give the details of such change. The guidance note also describes what is principal business. We had come across a case where the assessee was a trading house. There was a trading business, but the assessee had also started some amount of service activity, and over a period that service activity had kind of increased. And in 1 year, the assessee got a scrutiny notice saying that you have stated that you are engaged in the business of trading. So why do you have such a large consumption of stores, and why do you have such a large consumption of repairs and maintenance expenses? Of course, one could explain that, look, I have other revenues also, but what I'm trying to say is even these simple things should kind of, one has to spend time and one has to look at if there are any changes. One has to give adequate information so that there are no flags, so that there are no mismatches and no triggers, because sometimes simple disclosures could simple non-disclosures invites triggers and invites scrutinies. Then again, any material changes, and obviously you can mention more than one. You don't have to mention only one business. You can mention more of the activities. So it could be trading, manufacturing, it could be services, it could be information technology, it could be anything. And wherever there is business reorganization, we see a lot of M&A activities, a lot of demergers, a lot of acquisitions and all that. So if there is a new line of activity, it needs to be, the reference needs to be made. If it is a similar line of activity, M&A merger acquisition need not necessarily trigger any information here, unless it is a different line of activity, or unless it's a discontinuation of some line of activity. This is again on the presumptive taxation. Whatever is the amount which is liable to tax under the presumptive basis within the larger P&L, within the larger P&L, if there is a part which is assessable under a presumptive basis, then that information needs to be given. So this is more of a disclosure requirement. And in the presumptive taxation, the disallowances under 43B or the allowances in the subsequent years under 43B are deemed to have been given effect to. As far as losses, if there are brought forward business losses from the same business when the presumptive provisions were not adopted, when they were not opted, those losses should be permissible. So that one should be able to claim that deduction. Again, depreciation will come in the earlier provision. So depreciation is also deemed to have been allowed. And the last point is about the calculation of the turnover, which is eligible for 6% rate. Everywhere there is a reference to due date under section 139(1). Since the due date under section 139(1) has been extended, the extended due date also should be considered. And this extended due date should be considered not only for this clause, but also for other clauses like 43B and 40A1 and things like that, where you have the extended time limits for making payments for claiming deduction of those respective payments. Then we come to 50C. So 50C, as we know, is where the stamp duty value of a particular land or building is higher than the transaction value, and there is a addition which is to be made. There is a disclosure also which is to be made, and the disclosure has to be made in the tax audit report. So as a tax auditor, what do you do? So first thing is, when there is a transaction of transfer during the year, you will ask for the document and to have a look at what is the stamp duty value, because obviously the accounts will only have the value at which the transaction has taken place. We know that earlier there was a safe harbor of 5% that increased to 10% with effect from AY 21-22. And there is a small period where the safe harbor is 20%. And this 20% is only in respect of primary sale of residential units. And there is a threshold again of 2 crores. So we have to look at it from 2 angles. One is if the assessee, if the client is a seller or if the client is a buyer. So if the client is a seller, either 50C or 43CA would be applicable, depending on whether it is an investment property or whether he's in the business of, in the real estate business. If he is in the real estate, and when we say primary sale of residential units, then obviously we are talking about somebody who's in the real estate business. In that case, from 12th November 2020 to 31st March 2021, you can look at the safe harbor of 20%. For the balance period of the year, you have to look at a safe harbor of 10%. So that's an exercise which needs to be done. We will subsequently come to a case where the assessee is a buyer of the property, is a buyer of such property, or when the assessee has invested in such property. Now, if you are opting for that safe harbor, or if you are falling within that the difference of 10 to 20%, there is a specific disclosure requirement under the clause. So there are a couple of small changes in Form 3CD to take care of all these amendments. So that also needs to be reflected. Now we know that where the date of the agreement fixing the, where there's a difference between the date of registration and the date of agreement, then one can always take the benefit of the stamp duty value on the date of original agreement. We have recently come across a couple of cases where the tax department has taken a view that your letter of allotment is not agreement. Whilst the letter of allotment may be detailed and one would have, made those payments by account, pay, check and all that, the tax department has taken a view. I don't think that's a correct view, because there are decisions which say that a detailed letter of allotment tantamounts to an agreement. So that is the other thing we have to keep in mind. So when I mentioned that we are now no longer looking only at a factual a factual information. We are not looking at just giving the factual information. There is a lot of application of mind. There is a lot of subjectivity. So the moment we have such complex transactions, we will have to understand the nature of transactions. We will have to understand what are the provisions applicable, what were the provisions applicable in this case on the date of the original letter of allotment, and accordingly then give our comments, accordingly mentioned in the tax audit report. Now, if there are no adjustments under Section 50C, then obviously there is no disclosure, but you will need to have backup papers to justify that when there is a question during the assessment. Similarly, there have been, time and again, we've received various questions as to whether 50C is applicable in case of, say, transfer of flat under construction. So whether that is, because what the section says is any rights in any transfer of land or building or both. Now, a flat under construction is neither land nor building nor both. It is just rights in the flat. So it is not an immovable property. It is just rights. So there have been views that Section 50C is not applicable. Similarly, in case of development agreement, transfer of TDR, FSI rights, the guidance note surprisingly has said that in such cases, you will have to look at the facts and circumstances, and you will have to exercise the professional judgment. So one will have to take a call. Again, development agreement is basically a right in land. So perhaps one may be able to take a call that this is not land, it is only rights in land. Similarly, FSI is not land, or leasehold rights is not land, and it is only right in land. Although under Transfer of Property Act, you may have to see what is the definition, because under Transfer of Property Act, leasehold rights exceeding 12 years tantamounts to any movable property. So one will have to look at different provisions, different laws also at times before taking a call. Similarly, if there is a transfer of depreciable asset, if the capital gains are chargeable under section, under the block of assets, if the block of assets does not, if there is still a value remaining in the block of assets, if it continues to exist, then one will not go to Section 50C, that it is possible to take that view. But if there is no block of assets and there is a capital gains which arises, then one will certainly have to look at the stamp duty value. This is an important clause of fixed assets, and again, I will share a couple of practical, issues that we have faced in the past. Obviously, all the details, all the additions to assets, all the figures will have to be reconciled. You will start with the opening block of assets. You will start with the closing WDV of your last year's tax audit report, and you will start with that. You will take the additions from the additions to fixed assets. as far as deduction to fixed assets is concerned, you will have to take only the sale value, the actual sales consideration. Here, couple of things that you need to keep in mind is if there are any disallowances that you have made in, the item of capital expenditure debited to P&L account. So there are times when, certain assets are debited, are fully depreciated and debited to the P&L account, and one discloses that in the tax audit report. So that needs to come in as an addition to the fixed assets. There could be instances where there is an amount of disallowance of interest under 36(1)(3) relating to fixed assets. That amount should be included in your additions to fixed assets. And also, if in the earlier years assessments, there have been some additions made, some expenses which have been claimed as revenue and added by the assessing officer as being capital in nature, you will need to take the impact of that when you are when you're finalizing your clause 18 fixed assets. And I mentioned about a practical challenge. So when you have to give the dates of put to use, and you have to give the dates of 6 months below, within 6 months, within the first 6 months and subsequent 6 months for the purpose of determining whether it's as per the rate or it's 50% of the rate. So in one case, in the date format, there was some challenge. So instead of saying 8th of October, it came as 10th of August or vice versa. And whilst the calculation that we had made was correct, but since the date was put in a different format, the tax department recomputed the depreciation based on the dates that it took as per the format of the income tax department. So these are smaller things, which sometimes create practical challenges, and we have to actually then fight it in a way. So this, I thought, is something which we need to keep in mind. Similarly, depreciation is allowed when the asset is put to use, especially the additions to assets in the FAG end of the year. That's a very common question by the tax department. They would ask for evidence for the asset being put to use. So that is something which, when you are certifying anything, that those documents should be, the appropriate tax files should be kept in place. When the assets are sold, there's no depreciation allowable. So this is a specific clause which is applicable for 21-22. And as we saw, that 115 BAC, which is the lower rate of tax for individuals and HUFs, if one opts for that, there may be an adjustment to the written down value, or if there is an unabsorbed additional depreciation. So that is something which you will need to keep in mind. Another relevant thing, and a relevant, a question that has been often asked is, if the new regime for companies under section 115 BAA, which is the lower rate of tax of that 22% and surcharge and no MAT tax. So if a company wants to opt for that lower rate of tax and not opt for MAT, it does not want to be covered under MAT, then what happens if it has unabsorbed depreciation, which is in the nature of additional depreciation? Unfortunately, in AY 21-22, that adjustment to the opening WDV is not permissible. So which means today, if I have unabsorbed depreciation, unabsorbed additional depreciation, say of 3 crores, that 3 crores becomes a complete loss. It lapses because I cannot use it, neither can I add it back to my WDV. Had I opted for the new tax regime last year, which was the first year, that is assessment year 2021, then I would have been able to adjust that unabsorbed additional depreciation, adjust that or add that to my written down value. I cannot do that in year 2. So this is something which we need to be mindful of. The other, very important issue is about goodwill. Like we all know that because of the amendment in the Finance Act of 21, Goodwill is no longer a depreciable asset, and this is whilst the government had promised that there would not be any retrospective amendments, this amendment has come with effective from AY 21-22. So in effect, it is retrospective because it's come in the fag end of the financial year. And a number of large companies, a number of entities who have got large amounts of goodwill because of certain reorganization, certain acquisitions, in some case actual acquisitions, from non-related parties, they will not be able to claim depreciation on goodwill. And there is an interesting working about what is the adjustment to be made to the particular block of asset if there are other assets in that block. So if the company does not have any other assets in that block of intangible assets and goodwill is the only asset, you have to stop claiming depreciation. Whatever has been allowed in the past is allowed, and you will not get it going forward. In the year in which you finally sell it, you will get a deduction only of the balance WD. What happens if you have any other asset? It's a very interesting working, and I will share it with you in a minute. We've got some example. So how will that WDV reduce? Because what it says is you will continue to get depreciation on the balance intangible assets, but how will you determine the WDV? There is a rule and there is a working. So I am given this example. So in the year one, there was an acquisition of some trademarks at 200 rupees. You get depreciation of 25%. So you get a depreciation of 50 rupees. WDV is 15 rupees, 150 rupees. In year two, there is a goodwill on purchase of business. You come to your opening WDV, you have an addition of 500 and you get a total depreciation of 162. Similarly, in year three, there is a sale of some trademark. One of the trademarks has been sold because there were two trademarks. One of the trademark has been sold, and you come to a opening. Basically you come to a opening WDV of 133. Now what happens? How much do you have to reduce, and on what amount you will get the depreciation? So when we look to this rule, when we look at Rule 8C, what it says is you will have to reduce from the WDV, you will have to reduce an amount which is your WDV of, assuming that there were no other additions. So which means I have to work out my WDV of 500. When I work out my WDV of 500, in year two, my WDV is 375. In year three, my WDV is 281. And in year four, my WDV is 211. So my WDV is more than the aggregate WDV because of a reduction in the past. So what happens is then there is a trigger of capital gain. So I have to reduce 210 from this opening WDV, and there is a short-term capital gain or notional short-term capital gain under Section 50 of 77. So if there is even a small, intangible asset, there could be a significant amount of trigger of capital gains. So this is something which one will need to keep in mind. We come to another retrospective amendment under this 3615A, so which is contributions received from employees for various funds. We know that this has been a bone of contention with the department since the last so many years. And whilst there have been Supreme Court decisions, there have been specific Bombay High Court decisions, Supreme Court decisions thereafter, where they have said that as long as you make the payment of the employee's contribution within the due date, it should be, they have put it on par with Section 43B, and as long as the payments have been made within the due date of filing the return of income, there is no disallowance which should be triggered. So there has been this amendment saying that the employee's contribution to provident fund will be disallowed even if it is deposited before the due date. So there has been a specific amendment saying that this will be disallowed. So I think this, even if the disallowance is, of a very small amount, it is because of factors beyond control. It is because of various, especially we know because of COVID, because of the pandemic, because of the lockdown, there have been so many challenges. It says that if the contributions have been deposited late, you will not get it. It's a permanent disallowance, basically. You will not get it as a deduction. Of course, there are questions about, in the case of a new company, there are times that the allotment of the PF number, because now everything is supposed to be online, because of the allotment and all, sometimes takes more than 2 to 3 months. What happens? Because unless I have a PF number, unless I have an account, I cannot deposit. So there is a delay there. One may be able to take a stand that this is not a delay because this is an impossibility of performance. I could not have paid it in the absence of an account, and so the provision should not be applicable. Then we come to this clause about different kinds of expenditure debited to the P&L account. It is capital expenditure, it is personal expenses, it is payment to clubs, etc. And these, it's very so very often one has seen 143(1) intimations just taking figures from some of these clauses and making a disallowance. So whilst I understand if there is a capital expenditure which is debited to the P&L account, it has to be disallowed because a capital expenditure cannot be allowed. But if it is details of payments made to clubs, unless it is life membership fees, which also depending on the facts of the case one may be able to argue, but if it is regular membership fees or fees for using the facilities of the club, there is no question of those expenses being disallowed. But we have seen cases where under 143(1)(a) or 143(1) orders, these adjustments have been made. So I mean, that having said that, this is a factual reporting. The reporting will need to be done, and if there are adjustments made, one will have to litigate that out. One will have to, either get it rectified under 154 or one will have to litigate it out. One of the common adjustments made is because of this penalty, and there are two clauses, or there are three clauses. There is one clause for penalty for violation of law. One clause for penalty other than the above, penalty or fines other than the above. And the third clause is for payments which are not under law. So one will have to be very careful as to, where to disclose and what would be the correct place to disclose. So if there is a penalty for violation of law, that would certainly, that would in all probability be disallowed. But if it is more of, compensate one, if it is in the nature of a compensatory fine, that would certainly be allowed in the course of the business. One will have to look at the facts, circumstances, document it, and accordingly reflect it in the relevant clauses. Normally, any delayed fees or like you have your ROC charges, sometimes when there are delays, there are those additional fees. They call it additional fees. So all that is probably not even a penalty. So those kind of amounts need not even be disclosed here, that they may not even be applicable here. So one will need to see the facts and take a call. Then we come to amounts inadmissible under 40A1. We know 40A1 is payments made to non-residents where tax has not been deducted, or after having been deducted, tax is not paid within the due date of filing the return of income. As long as you have paid it within the due date of filing the return, it is allowed. And now one will need to look at the extended due date. One of the practical challenges here is you may finalize the tax audit report. Say today we are in the month of October, say by October end, but the return may be filed only in the month of Jan or Feb, as the case may be. So what happens? I mean, whilst your tax audit report says that this is inadmissible, you will certainly be able to claim it there. And we normally, you know, put a clause in the tax audit report in the note saying that all the details given under these clauses are up to the date. You know, it goes without saying that they are up to the date of issuing the tax audit. So one will certainly be able to claim it while filing the return of income, as long as, you know, it is actually paid before the return is filed. Similarly, the other thing one needs to keep in mind is whilst there is a 30% disallowance if the tax has not been deducted or not been paid for payments made to residents, for non-residents the disallowance is 100%. And also if the tax has not been deducted on 31st March, then even if it is paid before the due date of filing the return of income, it will still be disallowed under 40A1 or 40A1A. So that is something which needs to be kept in mind, because there it will be allowed in the subsequent year. And this clause needs to be cross-tallied with clause 34A. Clause 34A is the, you know, it's the most, I would say, bulkiest clause of tax audit, because there is an almost impossible task of reconciling all the possible expenses and TDS. Of course, I think each assessee, each entity takes a view as to whether to consolidate only the expenses based on the TDS returns filed and give the details of give all those details, or whether to try and reconcile the expenses. Then there are other amounts inadmissible relating to, you know, where equalization levy is applicable and it is not paid, relating to amounts in excess of amounts paid to partners in excess of the limit specified, and so on. Another important provision one may need to keep in mind this year is whilst 40A4 is an old clause, you know, it's an old clause talking about an amount which is disallowable in respect of payment to PF or other funds established for the benefit of employees, have to be disallowed unless the assessee has made effective arrangements to secure that tax shall be deducted at source from any payment. So we know that typically in majority of the cases when there are PF funds, there are very rarely instances where there is a tax implication, because either the employee will withdraw after 5 years or will take a loan. So it is very rarely that there would be a tax implication. Because of the amendments in the last 2 years, where amounts exceeding that cap of 7.5 lakhs is now liable to tax, you know, any employer's contribution in excess of that amount is liable to tax. Similarly, from this year, of course, this issue will be only from AY 23-24, or rather AY 22-23. This is about the interest on the PF contribution, which would be liable to tax because of the breaching the excess of 2,50,000. So in those cases also, it is very important for the assessees, for the larger assessees who have their own PF trust, to get into, you know, to set up a process for withholding taxes, let's put it that way. Whilst there is no clarity as to whether the trust should deduct the tax or the company should deduct the tax, it seems to be reasonably clear that the tax, the tax would be payable as salaries, and TDS would have to be deducted accordingly. So whether the company decides to undertake the liability of TDS or the trust decides to undertake the liability of TDS, that becomes very important. So that is another interesting issue which one will need to keep in mind. A common challenge, I'm sure a number of us would have gone through, is the interplay between 43B and 40A7. So whilst any contribution where there is an approved gratuity fund would be covered under 43B, if it is a pure provision, it is covered by 40A7. So if it is a pure provision, then you do not have the concept of payment within the due date of filing the return of income. So you will need to keep that in mind. And sometimes one has seen adjustments under 143(1)(a) relating to this interplay between 40A7 and 43B. That is again something which needs to be kept in mind, especially if it is a payment which is made within the due date of filing the return of income to either a fund which is set up by the company itself, or to any other approved gratuity fund which is provided by various of these insurance companies. So that needs to be kept in mind. We come to another, 14A has been a bone of contention ever since, for the tax department and the assessees. Whilst 14A has been significantly diluted now that capital gains are liable to tax, dividends are liable to tax, one will still need to, maybe not consider the implications of 14A, but will need to keep this in mind at the time of filing the tax computation. So just to give a simple example, that today if the assessee has made investment in shares amounting to 1 crore and has borrowed the amount of 1 crore, paid an interest of say 10 lakhs. The assessee has received a dividend of 5 lakh against those shares. So under 80M, the assessee will be able to claim a deduction of 20% of that interest. So out of 10 lakhs, the assessee will be able to claim 2 lakhs. What happens to the balance 8 lakhs? It is certainly not disallowable under 14A, because 14A talks about, exempt income. There is no exempt income, because even when I sell the shares, I will be liable to tax. So the question is, what happens? Is it an allowable? Is the balance 8 lakhs allowable under my normal provisions, or is the balance to be disallowed? That can be, a bone of contention in the future. So one will need to think through and document as to what is the view that needs to be taken. So whilst 14A now has lost its teeth, it's significantly diluted, but it still may be applicable where such instances are there, where there is significant amount of interest paid, or any other, for that matter, even other expenses incurred. So if the assessee has an investment division and there are employees in that investment division, there are expenses in that investment division, can the assessing officer say that part of these expenses are attributable to dividend? Maybe partly it would be attributable to your investment activity, that means to your capital gains or anything else. But part of it is attributable to your dividends, but against dividends you get only deduction of 20% and the balance would be disallowed. So there could be, we could see such litigation in the future. So when one is finalizing the tax audit report and tax computation, these are things which one may want to flag out, at least have the thought process and the documentation ready, so that one is ready to answer questions. 36(1)(3) we saw, or we discussed about interest on capital borrowed. So whilst under the Ind AS and under the accounting standards, there is a concept of qualifying asset, and if an asset takes more than 1 year to get developed, it is only such interest that can be capitalized to the cost of such asset. But under Income Tax Act 36(1)(3) clearly provides, and also the ICDS 9 clearly provides that interest on capital borrowed from the date on which the capital was borrowed till the date on which the capital asset is put to use will not be allowed as deduction. So it will not be allowed as revenue deduction, which means you may need to capitalize it. ICDS 9 talks about the method of, capitalizing it. It talks about where obviously there is a term loan, then it becomes a very simple formula. Where there is no term loan, but there is other borrowing, then there is a formula to average out to see the average assets, average borrowing, and then take the average, interest. So that is something which will need to be done by the tax auditor while finalizing the tax audit. And we must remember to add it to the cost of fixed assets and claim depreciation. Certain assets which are, things like motor car or say computers, there one will always argue that there is no difference. There is no, whilst I have borrowed the capital, whilst I've taken a loan for the car, there is no time lag between the date of borrowing and the date of put to use. So in those cases, there may not be any disallowances and interest would be allowable as deduction. This is again the 48.2b. 48.2b talks about payments made to basically specified persons, and payments made to these specified persons should be will be allowed as long as they are fair and as long as they are not excessive or unreasonable. And related party transactions have been, in the forefront everywhere. We've been reading newspaper articles, we've been reading, shareholders' activities relating to resolutions for payments to related parties and things like that. So this is something which has to be taken basis the accounts. Whilst the definition of related parties under 48.2b may be different from what is defined as related parties under the Ind AS 24 or the earlier accounting standard 18, one will still need to reconcile and give all the disclosures. So there, no opinion has to be given by the assessee. Whilst when we are doing the tax audit, we do not have to justify as to whether it is reasonable or excessive or make any disallowance. But it is only reporting of the factual information. Having said that, when we are reporting on the factual information, we need to, it is a good idea to have the, backup information about the justification of this. Now, typically for larger companies where they are covered by the listing obligations, the related party transactions are all vetted by the board and they are all approved by the board. Having said that, one will still need to keep adequate documentation. Now, sometimes what happens, again, to give a very simple example, when you give details of related parties, suppose there is a payment of professional fees to a related party. So the question is, the professional fee obviously should be the amount which is excluding the GST, because the amount which is debited to the P&L would be the amount excluding the GST. If you look at the details, if you look at the ledger of that particular party, you will get the gross amount. So, very often that also one will need to try and reconcile so that there are no glaring or there are no mismatches, there are no gaps. So whatever are the differences that will need to be reconciled. Again, the figures reflected in your notes to accounts and the figures that are reflected in the tax audit report, one will need to reconcile. So as we said, whether the details should be gross figures or net of GST, so they should be considered as net of taxes, as the expenditure that is claimed is only net of taxes. Now, whether to be disclosed as gross or net of TDS, Now, actual payments to persons should be reported, but basically TDS is also, whilst TDS is not really a payment made to the related party, but it's a payment on behalf of the related party. So to my mind, one will need to show as gross of TDS. Payments made in respect of capital nature, whether should be covered. A better view is that also should be covered because that's a more conservative view because it is a payment made to related party. Similarly, reimbursement of expenditure. Again, if it's a pure reimbursement, one may need to take, one could take a view that this is not really a payment to a related party. So, for example, if the group company has bought Microsoft licenses and it's like a pass-through cost, I may not decide to show it. But if the group company is giving that to me as a service with some markup, then one would need to show it. Similarly, payment to directors. Again, there the question is what is the amount which should be shown, whether it should be the amount of salary in Form 16 or it should be all the proportionate say retirement benefits, etc. So normally what we would normally do is try and reconcile it with the figure which is disclosed in the notes to accounts, so that there is no gap, so that there's no difference. Now in the accounts, the related party, because of the listing obligations and all, may also include payments made to, say, the CFO or the CS, who is not actually a member of the board. But for 48(2)B, those people may not be covered. So there you may want to, ensure that only parties which are covered under 48(2)B have been included. This is again another interesting provision of Section 41(1). So basically a cessation of liability, and there what we have seen is, whilst in most of the cases one would have offered it to tax or one would have credited it to the P&L account, the moment you put it in your tax audit report, when the CPC is preparing, when the CPC is doing the 143(1), if this figure is not separately reflected in the ITR somewhere, it would take it again. So what we have done is we have normally added it separately under 41(1), but in the computation in the ITR, we would have first excluded it and then taken it under 41(1). So that is something which needs to be done, because otherwise there could be a double addition of the same amount. An interesting question is whether if a capital liability is written back, so if a term loan is written back, whether if there is a one-time settlement with a bank, or there is a process which is undertaken and a capital liability is written back, what happens? Whether it is to be considered as covered under 41(1). So there was this whole group of cases of Mahindra and Mahindra, which there was a Supreme Court decision which has said that basically a waiver of loan should not be subject to tax. Whilst in the past there have been cases which said that waiver of term loan should not be subject to tax, but waiver of working capital loan should be subjected to tax. But Mahindra and Mahindra, whilst the lead case did not have working capital loans, the lead case only had term loans, but the other cases which were merged with it had a lot of cases where working capital loans were also there, and the decision is applicable in all the cases. So it may be possible to take a view that even if there is a waiver of a working capital loan, you may be able to take a stand that this is not. Of course, if one is covered under MAT and the amount is credited to the P&L account, MAT would be applicable. MAT could be applicable. So that is another thing which one will need to keep in mind. And reversal of provision for bad and doubtful debts should not be covered under 41 if the provision has not been allowed in the first place. So the whole idea of 41 is that if something has been allowed as a deduction and you have not made a payment of that money, and you are now no longer liable to make payment of that money, you should make good the deduction that you have got, and so it should be liable to tax. So that is the basic logic of that provision. So in certain cases where the liability has been reversed, now these are very specific cases. So what happens that if a civil liability is cancelled by the court order, but the opposite party is in further appeal, so what happens? Is there a cessation of liability? But there also one may be able to say that today the liability is still there. I mean, it is still contested. It is not complete cessation. So on case-to-case basis, you may be able to say that there is no cessation. Similarly, in case statutory liability is decided in favor, but there is further appeal. So what happens? But if the monies are received or if the refunds are received, then it would be liable to tax. And if one has to make good of it, at that point of time, you would get a deduction. Again, liability reversed and credited to P&L pending appeal. So it would be liable to. The accounting treatment that you do would also determine what is the tax implication. 43B, we are familiar with it, but I'll just take you through an example. Because this is again a trigger for adjustments, because there are two clauses. One is your opening for earlier years and one is for the year. So we'll just look at an example. So there are two parts. One is part A, where the liability pre-existed on the first day. So if we can see the example below, if there is an opening outstanding liability from the previous year of 1 lakh, whatever, and out of that 30,000 was paid up to March 21. So the closing liability is now 70,000. But out of this 30 lakhs, if 10,000 was paid up to Jan 21, which means before the due date of before last year's due date, and it was claimed last year, then what you will get this year is only 20,000. And if you have claimed another, if you have paid another 25,000 up to the due date of filing this year's return, you will not get this. Basically, what you get as deduction is only what out of the opening balance, only whatever you have paid during the financial year. It is only the liability which is accruing in the current financial year. For that, you have time up to the due date of filing the return. Now, this is a simple thing, but typically, you know, there is confusion because most of these liabilities are lying in one account. So one will have to see as to whether you want to take a FIFO or you will be able to identify the liability year-wise. What we normally advise our clients is that each liability of each year, you should keep it separately. And this is normally more in case of employee-related liabilities. So to give a similar example for the current year, whatever is incurred during the current year, 1,25,000, whatever has been paid during the year, obviously it is allowed. Whatever is paid up to the due date will also be allowed, and the balance liability will remain. So here also, normally we would, you know, working papers need to be there, because very often when the figures are mentioned, I mean, there needs to be backup working paper so that in case of scrutiny, they can be easily explained. An important issue which is likely to arise this year is what happens because of, you know, whilst moratorium was given last year, but there was also a lot of restructuring of debts and maybe even a number of cases where waivers were given. So there what happens as to whether the interest, if there are delays, whether the interest would be allowable, or if the outstanding interest has been converted into fresh loans, what happens? Now clearly, you know, the amendment clearly provides that if any interest has been converted into a debt, it will not be considered as it would not be considered as payment. So only when you're repaying, so if an interest is converted into a debt, when you're repaying back that principal, the interest which has now become a principal, when you're repaying back that principal, you will need to remember to claim it as a deduction under 43B, because that amount has already been disallowed to you. So that is another working which you will need to maintain. Another interesting issue is about 5627B, where the premium received on issue of shares is sought to be liable to tax in certain circumstances. And you would all remember the hue and cry which had happened about 3 years back when the department had levied tax on such premiums for these startups. So there were a number of startups which were able to raise money from non-related parties at very high premiums. Those premiums perhaps could not have been justified by way of either the net asset value method or by way of projections, because those projections were really, very, very aggressive. But the non-related parties believed in those promoters, or believed in the idea of those promoters, or believed in the technology of those promoters, and were willing to give them high premiums so as to be able to take the idea to the next level. And thereafter, there were these notifications by the tax department saying that in case of startups which are registered startups, these provisions will not apply. So startups aside, what happens to other companies which are not startups? So other companies which are not startups and are issuing shares at a premium, then if the shares are issued to non-residents, this provision would not be applicable. If the shares are issued to residents, then one will need to see the valuation. One will need to see either the book value, the net asset value, or one will need to see the discounted cash flow valuation. And typically, the tax department has in the past been taking a view that when they look at discounted cash flow or method of valuation, because it is based on future projections, and the assessment comes after 2-3 years, the department has the benefit of hindsight, and the department then tries to question the presumptions taken on the basis for taking the projections. That is something which sometimes creates a problem. But as long as the projections are reasonable, and as long as the valuation is justified on a reasonable basis, I think one will be able to take a stand that there cannot be any adjustment. Here, an interesting issue had come in one of the cases where shares were issued both to residents and to non-residents. Now, when the shares were issued to non-residents, the provisions are not applicable. And the provisions are not applicable. However, when shares are issued to non-residents, one has to keep in mind the provisions of FEMA. And FEMA says that you have to issue shares at a higher of any internationally accepted valuation methodology. So we actually had a valuation report saying that the value is say 290 rupees, and the shares were issued at 300 rupees, because it kind of made more sense, and RBI said anything 290 or above. So we issued at 300, and at the same time to residents also shares were issued at 300. Assessing officer obviously asked that why will section 5627B not get triggered, because you have a valuation report also which is saying 290, but you've issued at 300. Whilst in this case, the amount involved was very small, but the explanation that one had to give was saying that, look, we have issued to non-residents, who are an unrelated party. This is a rights issue. We cannot have a rights issue where we have a differential rate. We have to issue to both my shareholders at the same rate. So there is no option. So if you see, and we will go to the next slide, which says, so basically it says that as long as the assessee is able to substantiate any other value other than the NAV or DCF before the assessing officer based on the value of the assets, including intangible assets such as goodwill, patents, trademarks, copyrights, licenses, or any other commercial rights of similar nature. So we could actually explain to the assessing officer that, look, because of our our goodwill and all our relationships and all, we have been able to get the value of 300. So this is a fair value. And in that case, the assessing officer accepted, even in the case of a resident, that this value is acceptable and no addition under 5627B is triggered. 5627B is not applicable to a venture capital undertaking. This is and angel tax also we discussed, so we'll not take too much time. If the fair market value under 11 UA is 8 rupees per share and shares are issued at 10 rupees, can there be a trigger of 5627B? The answer to that is obviously no, because the section itself says any value in excess of the face value. So as long as you're issuing up to the face value, there's no problem. And I think under the Companies Act, you cannot even issue shares below the face value. Optionally convertible preference shares will be covered, so you will need to justify. Warrants issued may not be covered because warrants are not shares. Now, a number of cases there are warrants issued, but it would not be covered. Maybe in the year of conversion, one will have to see whether the provision would be triggered. Same thing for optionally convertible debentures issued during the year. In that year, it is not an issue of a share, but in the year of conversion, one may need to see. Perhaps in the year of conversion, one may be able to take a view that there is no money received during the year, because ultimately 5627B talks about receipt of monies towards issue of shares, but one will have to take a view in that year. Shares issued at premium to both resident, non-resident, we discussed. This is again a reporting requirement. I think we have another 10-15 minutes. 56 to 10. This is again an interesting provision, especially when we are looking at tax audits of individuals and HUFs. And again, interesting thing is if one is looking at a tax audit of an individual who's got a proprietary business or a profession, proprietary profession, there what does one do? What we have done and what has worked for us is we have always segregated the business from the personal, transaction. So we have actually prepared separate books of accounts for the business activities and have called it Messrs. ABCs, so and so. So for example, suppose it's a practicing chartered accountant, his or her personal assets and personal liabilities and personal data is kept separately. What is culled out is only the professional things, and the tax audit is done only in respect of the professional piece of it. The moment you do only the professional piece and you are certifying the the balance sheet, the financial statement, the income and expenditure and balance sheet only of the professional piece, a lot of things perhaps gets out of the anvil of tax audit, and that has worked for us. That aside, when we come to 56 to 10 for a minute, we assume that this is all merged and there are some gifts received, then what happens? We will have to look at all of this, or there is a purchase of immobile property, and there is a difference of more than 10% or difference of more than 20%, then these reporting requirements get triggered. And the moment something is reported, obviously there is a tax implication. It needs to be offered for tax wherever it is due. There are some of these decisions which I will, I'll be happy to share the presentation and one can look at it in leisure. So there are also these provisions. Now, these are all mathematical formulas, so we will not take too much time. So this is all very factual, fact-based reporting. When we talk about secondary adjustment or when we talk about the interest adjustment, these are all very, very fact-based. So if there is an adjustment made, what is the amount of adjustment? If the amount of adjustment is prior to 1617, no secondary adjustment. If the amount is post 1617 but below 1 crore, no secondary adjustment. If the amount is above 1 crore, then there is a method to do secondary adjustment. If the money comes in, what happens? If the money doesn't come in, then there is an interest which needs to be considered. So these are all mathematical formulas, and this needs to be reported. So which means what has to be done is you will have to go through the assessed, the transfer pricing assessments in the earlier years. You will have to go through whether those assessments have been accepted, whether there are appeals, because all this is where these are undisputed, where there are no appeals pending. So you will have to go through all these details before you make any report over here. So we quickly saw what are the secondary adjustments. So it is all arithmetical formulas which need to be applied. For interest also, there is an arithmetical formula where when we are talking about excess interest, there are formulas put total interest, there is EBITDA, 30% of EBITDA, and if there is a differential, then your entire interest that you pay to the associated enterprise may not be allowed. And it would be, the allowance would be restricted basically to 30% of the EBITDA. These are mathematical formulas. 269 SS and T are old transaction. I mean, these are very old provisions about loans and deposits, and by and large things have been settled. One question which often comes is what happens to entries by, what happens to journal entries, what happens to transactions by way of journal entries. Of course, disclosure needs to be made, but wherever the journal entries are actually backed up by account payee checks, we have seen instances where the tax officers have accepted those transactions and have not levied any penalties. But adequate disclosure, adequate documentation, and the fact that eventually it is backed up by account payee checks needs to be mentioned. We will look at 269 ST. This is a relatively new provision where the amounts paid in excess of 2 lakhs in cash. So there are three categories. If it is paid in excess of 2 lakhs to one person, to a person in a day, or in respect of one single transaction, or in respect of transactions relating to one event or occasion to a person. So we will see some examples and as to where it could be triggered. So now, because these are again, common questions that we have come across, and which is the reason we thought of putting it. So cash gift received on the occasion of marriage amounting to rupees 10,65,000 in aggregate. Will it be covered? Now, if we see that the limit is even in respect of an event, so the event is one, but it says from a person. So as long as you are able to prove that you have not received more than 2 lakhs from a single person, this should not trigger a penalty. Similarly, in this case, cash received of 2,50,000 from a customer in a day against 5 invoices of different dates of 50,000 each. Here, it would be triggered because you are receiving in a day a transaction from one person in a day. So here it would be triggered. Cash receipt during the year towards partners capital account 50,000 every month aggregating to 6 lakhs. So it is neither for one transaction because these are separate transactions. Every month there is a separate transaction. Neither it is on one day 2 lakhs. So this should not be triggered. Whilst there is this decision of the Supreme Court, this is an old decision saying that capital contributions are not hit by Section 269 SS and 269 T, which is that 20 lakhs loans and advances. There is a decision, but however, you know, as far as possible to be on a safer side, it makes more. I mean, this is what even the Supreme Court said, that it makes sense to comply with all these provisions. So wherever possible, you know, considering the encouragement that is given towards digital payments, I think wherever possible, as long as the cash payments are minimal, that is something which the tax officer will be happy, and I think we should, you know, try and do that. Cash withdrawal against drawings by partners every month, 25,000 aggregating to. So this is again similar like cash receipt towards partners capital account. It is on the same analogy. Sale of personal motor car for cash, 2,50,000. This would certainly get triggered. No, this would be covered irrespective of whether it is personal or business. So loans and deposits we saw. I think this last issue we will just look at brought forward losses. So here again, practical challenges that today the scrutiny for say AY 1819 or 1920 has been completed, and the loss figure has been amended. The loss figure has been reduced. When you have filed the return for AY 2021, you have obviously claimed the return loss. So you did not have any further detail, or you did not have any other details. When you're filing the, when you're preparing the tax audit report for AY 21-22, what happens? You will obviously need to take the assessed losses in mind. You will have to take impact of the assessed losses. Practically, what happens is, suppose 2 years from now you get some relief, you get part relief or you get full relief. How do you, the time for revising your return has gone, the time for you know, making any other claim has gone. It is very important for you to keep a track, for the assessees to keep a track, that whenever such a thing happens, immediately a rectification application is filed and you know, the benefits are claimed. So when we look at this clause 32, you will have to first compare what is disclosed in the earlier year. You will have to compare the returns filed. You will have to compare the assessment orders, and you will also have to compare any appeals or any appeal effects which have taken place, and accordingly give the disclosures. So this is a very important clause because it's important to, you know, have made the right claims. So for example, if some reliefs have been given in you know, during the year, and some appeals have been passed in favor, you will need to take cognizance of all that when you prepare this particular clause. These are chapter 6A deductions, again factual. Clause 34A is a combination of factual and subjective. So I think there it's very important to do certain basic things. So one is the TDS, TCS figures, as per the TDS, TCS returns have to be reconciled with the figures in the books. It may not in all cases be possible to reconcile with all the expenses. Because you would have, so for example, if we look at a we look at a 194C or a 194J, you would have expenses falling in various different heads, which would form part of payments to contractors or professional fees. So you will have to start maybe with the TDS return and then do a backward working, depending on what is the kind of documents that are available with the assessee. So basically, the assessee will have to prepare the annexure, and you will have to then cross-check the annexure with the TDS returns, with the entries, with the TDS and TCS ledger accounts. But this is a very important factual reporting, so one needs to kind of be mindful and take care. And wherever now we also know that one of the triggers for scrutiny, or one of the important points in scrutiny, is always your reconciliation of 195 payments. So the details of 195 also, it's very important to reconcile, because today it is also possible to download all the 15 CAs and 15 CBs which the assessee has filed. So that is another, a cross check which can be done. So TDS on year-end provisions, completeness, foreign payments, wherever there's a judicial divergence, you will need to document it. Quantitative details is factual. SFT is again factual. This is my last slide, I think. So some of the common challenges or the common errors, which we have also found over the years in, in various assessees, the date format, change of year, related party transactions, 43B transactions, Part A and Part B, gratuity bifurcation 48.7, 43B, then the TDS disallowance clause versus 34A, depreciation more than 180, less than 180, the bifurcation, unabsorbed depreciation, business loss, cross tally with the ITR. And sometimes when we try and put notes in the Form 3CA, because there is a limitation of number of words, that it's very important to kind of draft it properly so that it doesn't lose its meaning. And can tax audit be revised? So I will leave you with this thought, and if anybody has any comments or any different views or different experiences, happy to hear them out. So thank you for a very patient hearing. Thank you, everyone.
Thank you, ma'am. Do we have any questions? Mishra ji, do we have any questions?
दो मैम दिया क्वेश्चन, एक क्वेश्चन दे देता हूँ.
Ma'am, we have one question. Export benefits are part of turnover.
Yes. So they are part of gross receipts of business.
I think that's the end of the question. हाँ, बस this is the end of the questions. हाँ.
क्वेश्चन नहीं है एक भी.
अच्छा, okay. So on behalf of WIRC, it is my proud privilege to cast a vote of thanks to Saroj ma'am. Feeling gratitude and not expressing it is like wrapping a present and not giving it. So please accept our heartfelt gratitude for enthralling us through your words of wisdom. We would like to express a deep sense of appreciation to you, ma'am, for guiding us on this topic, sharing your precious thoughts with our participants, and sparing your valuable time with us. Thank you very much, ma'am.
Thank you. Thank you.
So now moving on forward to this session and taking us to the quiz time which we were waiting for. May I request Wrinkle Gorwala to please take over and take us through this eventful quiz after a wonderful session on this Navratri evening. Wrinkle, are you here?
हम ज्वाइन कर रहे हैं.
We'll need to wait for 2 minutes till Wrinkle joins. Kindly bear with us. Due to technical issues, Wrinkle would not be able to join the session. So thank you all the participants for your active participation and listening to our session and being a part with us this wonderful evening. Thank you, everyone. Mishra ji, we can wind up.
Okay, madam.